Hello, and welcome to Fund in Focus, where we review ARK Invest's funds and answer some top advisor questions about those funds. I'm Brett Winton, ARK's chief futurist, and with me I have Tom Staudt.
Thank you, Brett. Yes, we're going to dive deep into ARKX, the ARK Space Exploration and Innovation ETF today. And, you know, I would be remiss if I missed the opportunity right off the top to say that this fund is probably, for most advisors, a satellite allocation as part of their portfolio. And so with that in mind, how should advisors think about space exploration, about space, relative to, you know, the rest of their book, a more traditional portfolio, more traditional allocations, even within equities?
Well, the technologies that this fund is exposed to is reusable rockets. There's been a collapse in the cost of lobbing things up into space, but not just orbital space. It's also exposed to aerospace, between space and the ground. And so there's also kind of a strong defense representation here. So anybody who's been paying attention to geopolitics in Ukraine knows that the ability of drones to change kind of the battlefield is really at an inflection point. And drones are not just good for fighting wars. They're also good for, doing Earth observation of kind of agriculture and construction machinery and delivering things from place to place. So you can think of this as taking advantage of the declining cost of rockets and all of the demand that unlocks, including being able to have satellites, very close to Earth, so you get much better airline Wi-Fi, for example, which is tremendous. And taking advantage of everything that's going to be going through the air over the next few years as kind of parcel drones reach scale, as vertical takeoff and landing craft are able to take us from place to place, we think at roughly the cost of a taxi on a per mile basis. And as construction and agriculture transforms to accommodate these new technologies. Of course, all of this is accelerated by artificial intelligence, which makes a lot of it possible. And in the case of aerospace, 3D printing plays an important part in enabling some of these new form factors to get to market.
I mean, I think a lot of advisors, they think space exploration. I mean, space in and of itself, they're thinking, Alan Shepard and John Glenn and Neil Armstrong, the right stuff. I mean, NASA, right? I mean, this space has been a government-funded operation. Now, suddenly we have a fund entirely in the private space, a private enterprise. How do these companies make any money? I mean, how is this a business line?
Sure. Well, if you have a declining cost of rocketry, then you can much less expensively put up satellites, and then you can charge for access to those satellites. So, for instance, Iridium is taking advantage of cost decline to launch a constellation of satellites that are low Earth orbit, meaning that they provide global coverage to things like infrastructure and industry that otherwise would have a hard time with connectivity. And it's, of all the technologies that we study, rocketry is one that was steadfastly not following our cost decline curve until the industry began to truly privatize as opposed to being cost plus. And so if you look in this portfolio, you wouldn't see some of the usual suspects that you might have in a space fund. Instead, you have what we see as the beneficiaries of the innovation that SpaceX is delivering to the market, as well as kind of all of the component and suppliers that are feeding into kind of the suborbital space and delivering those capabilities.
Now, you mentioned something there. People have been paying attention to this. SpaceX obviously is a name. Elon Musk gets a lot of the attention in terms of the private enterprise space business, I guess, for lack of a better phrase. Maybe Bezos and Blue Origin. Obviously, neither of those are in this portfolio because they're not publicly traded equities. So how is there a fund without that? And also, what is in the portfolio then in terms of some of the names?
Sure. So Yes, private enterprise is the right word for it because they are private companies not publicly listed. And so within an actively managed ETF like ours, you can't effectively package a private exposure because you have to have daily liquidity. We do have a venture fund that does have SpaceX as a very large holding in it. And so kind of that SpaceX exposure is expressed elsewhere in our suite of products. But Iridium, I mentioned, Kratos and AeroVironment are both do supply drones for kind of military use, including, you can imagine, like, why are we putting very expensive and dear pilots' lives at risk flying high-performance fighters when potentially, we can fly them as drones and they can be more performant. And so Kratos is involved in kind of like that next generation of aircraft that won't even put human lives at risk, on the airframe. And there's kind of, like I said, vertical takeoff and landing companies like Archer and Joby. So even in the 2028 Olympics, we're hopefully going to be flying around Los Angeles to get over traffic in one of these things. I certainly am looking forward to it. And so you can imagine that the way in which we get from place to place and things get from place to place could transform.
Do you have to accept a thesis that globally spending on defense is going to continue to increase to have a bullish outlook for this fund, or are there natural cost declines and growth economics separate and distinct from geopolitical uncertainty and government allocation processes?
I think you can make a strong case that defense budgets are going to continue to grow.
It does seem, unfortunately, like that is true. I would agree with that.
Yeah, and I mean, you don't have to shift that much share of defense budget from like giant ships into smaller drones in order to drive a lot of top line growth for kind of these military exposed.
Which is certainly
positions.
where these stocks are reacting to, is on that top line growth.
Exactly. And so you could have shrinking military budgets, and the way in which you would shrink it, you'd be like this, tens of billions of dollars fighter program. We would be better off devoting that towards, a swarm of much smaller aircraft that can actually overwhelm the defenses of an adversary. And that's one exposure here. So the cost decline in rocketry and everything that unveils, that's all kind of found opportunity. As well as kind of vertical takeoff and landing, everything that's happening on kind of like the ag and construction side. And really, like, one of the real catalysts and drivers here is the data that you're getting off of all of these systems, and your ability to loft them and efficiently operate them is enabled by artificial intelligence. And so if you have even if you look at a like city police department, in LA, we have, I think it's the largest helicopter force in certainly maybe the world, but it's the largest helicopter police force in the US. Very loud, very expensive to operate. And they don't do that much good. They like ride around after car chases. I'd much rather have like a set of drones that can loft and observe and actually provide data back to the police to more effectively police the city in a much less obtrusive way.
It's interesting when I look at the composition of the portfolio of ARKX relative to, really any benchmark or really any other ARK fund. I'm struck that the halo of the style boxes in which it covers, the circle covers every single box, all 9 of them, right? So and the centroid is almost right in the middle, implying that this fund is not a growth fund, it's not a value fund, it's not a large cap, it's not a small cap, it's almost separate and distinct from that. As a result of that, in the very indexed benchmark heavy world that we live in, how much exposure do people, do advisors, do clients, do investors actually have of any of this stuff in their portfolio right now, if they would go through starting to try to find it?
I mean, I would imagine very low, though you'd probably be better place to answer that question.
Not many of the names you mentioned, right, are there. I mean, obviously, there are some names who are space adjacent, your Boeings of the world. Some of your other defense might get into there in different parts. But that's not really where the top of this, that's not where the real weight of this fund is.
Yeah. And I mean, I think as with kind of other disruptive technologies, there are, like Boeing's an example, that's a company that's being put to risk for having essentially harvested its innovation engine and eaten it alive over the past 2 decades, right? And that opens up a market opportunity for the likes of Rocket Lab, a small rocket company,
which
right?
is definitely not exposed in most portfolios.
Exactly. And so if you kind of and Kratos, like, so there's a set of companies that we think is going to take share from basically fat, dumb, and happy incumbents. And in this space portfolio, that set of companies is actually well distributed across kind of like the value characteristics, value to growth, and the size characteristics. And so taking an exposure here actually provides you with a hedge against some disruption that could come, including geopolitical disruption. So as you know, we all know everybody's concerned about what's happening in the world. Well, we can see the direction the ball is moving in terms of how we're going to protect ourselves. And this is a way to positively expose your asset base towards that direction.
I mean, am I wrong to think of this as, you know, to some extent, these are somewhat downside mitigated because they do have very large government contracts, whether you're talking about the defense side, and frankly now even in the space cargo side, there's still quite a bit of government allocation. But they also then have the upside of declining cost curves, of innovation, of expanding market segments in the enterprise, and some even on the consumer and commercial side that are not typically represented in government-funded, large, deep value type stocks. Is that? I mean, am I thinking about that the right way? Yeah,
I mean, I think. And this probably holds true if you look at portfolio performance. It doesn't track like a typical defense benchmark, right? There is kind of some growthier and more kind of top line oriented characteristics here. Ultimately the companies that we invest in are companies that we think are going to take advantage of the cost declines of the technology that they're operating in order to deliver not only top line growth, but then expanding margin. And so government contracting itself has changed, particularly in space. And so, Boeing, the reason Boeing was able to afford to basically harvest all of its engineers and feed them to the shredder is because it was just a cost plus business. You actually didn't need good engineering talent to basically ring up a bill. And so we think that actually engineering matters, and it's reflected in the exposures that we have in this portfolio.
So last question then is, you know, this is a pretty, the fund itself has a short track record. It's multiple years now, but a short track record. It wasn't really investable as a public equity fund before that. As an active fund that can act very quickly to new names, not forever as an index rebalance, let alone a name actually getting into the index so that investors and advisors don't have exposure. Do you expect the number of entrants that are public companies and then eventually in the portfolio as well to meaningfully increase over the next few years?
Yeah, I think it's likely. I mean, you can't say for sure, but as with all of the technologies that we focus on, we think there is a big appreciation tailwind on a forward basis, and that'll accrue both to the benefit of the companies that are operating in the space and publicly traded today, and it means that there will be enterprise creation that companies will list, and companies that are already operating in private at scale, could IPO. So,
we've certainly seen a very slow IPO market, understandably so, which has frankly been a headwind to some of the valuations of some of these companies artificially because they haven't had their new comps come in and IPO in the space. And it seems like something that could unlock, really multiple accretion as well as just general awareness and investor demand, which I'm not sure is really being priced into these names right now.
Yeah, it's actually an interesting point where if you think about the IPO process, and an investment banker gets paid to list a company, and part of that investment banker's job is basically to go around and convince people that the company is worth what it is. Yeah. If you don't have an IPO window open,
that's right.
You don't have these bankers walking around telling
exactly
people
right.
These companies are worth that. And if they can convince people of that, then they say, well, there's this company on the shelf that's very similar to this that's not trading at that range. And so it actually creates this virtuous cycle of kind of multiple re-rating across an entire sector. So I do think as capital markets open up, and this is an area where it could happen, in a slightly orthogonal way to the other technologies that we focus on, then you actually could end up with re-rating across a number of these names at the same time.
We'll leave it there. We thank you for joining us. And, of course, as Brett mentioned, space is relevant for the ARK Venture Fund, which is available for advisors or direct for retail consumers as well. And they can find that information in addition to the ARKX, ARK Space Exploration and Innovation ETF, which you can always find more on the website at ark-funds.com. Thanks for joining us today, and we look forward to speaking with you again soon.